Nokia stock is currently trading at $12.82 per share as of the market close on May 8, 2026 at 4 p.m. ET, marking a significant intraday climb of 3.81% during the last session. While the market is currently closed this Monday morning, May 11th, the momentum from Friday's rally has set a staggering stage for the week ahead. Most investors see Nokia as a legacy telecommunications company, a relic of the early mobile phone era that now exists to maintain 5G towers. The expectation is that this is a slow-moving, low-growth utility play. However, the reality is that Nokia has quietly transformed into an AI infrastructure powerhouse, securing a massive $10 billion deal with Nvidia and seeing a 49% surge in sales from AI and cloud customers. This isn't just about sell signals anymore. It's about the physical backbone of the global AI supercycle. While the casual retail trader is still looking at the high PE ratio and shaking their head, institutional money is flooding into Nokia stock because they recognize it as the last remaining Western sovereign-level supplier in a world that is rapidly restricting Eastern hardware. The tension in the market right now is palpable. If you look at the recent daily swings, we've seen single-day spikes ranging from 6% to 11% on heavy volume. This isn't typical behavior for a sleepy telecom name. Trading platforms like Interactive Brokers and Fidelity have seen a massive uptick in volume for NOK, often topping the lists for European ADR gainers. The technical setup is screaming that something has shifted. We recently broke through a major psychological resistance at $12, a level that has held the stock back for years. Since the beginning of 2026, the stock has surged over 73%, but many are still waiting for a pullback that never seems to come. This is the classic expectation versus reality trap. The market narrative says Nokia should be valued as a hardware manufacturer, but the reality is that their optical networking business, which grew 20% year over year, is becoming the primary driver of their valuation. When you see a company booking 1 billion euros in orders from AI and cloud customers in a single quarter, you have to stop comparing them to traditional service providers. Institutional activity is where the real story lives. We are seeing massive option activity, with over 78 million contracts traded recently, including deep interest in September 2026 calls. This suggests that the big players are positioning for a long-term re-rating of the stock. While you might be using Robinhood for quick fractional shares or SoFi Invest for its ease of use, the heavy lifting is being done by firms like Morgan Stanley and JP Morgan, both of whom have recently boosted their price targets. They are looking at the Infinera acquisition and the partnership with Lockheed Martin for 5G defense as the real catalysts. Nokia is no longer just a company that helps you make a phone call. It's a company that enables AI inference in the Asia-Pacific region and powers 1.6 terabit optical line systems that data centers desperately need. The reality is that as the AI supercycle accelerates, the demand for high-speed, secure, and Western-controlled infrastructure is going through the roof. Let's look at the numbers because they tell a story that the headlines often miss. In the Q1 2026 report, Nokia showed a comparable gross margin expansion of 320 basis points. That kind of margin improvement in a hardware-intensive business is almost unheard of unless there is a significant shift toward higher-value, software-integrated products. They have effectively become the main player in the AI-RAN space, utilizing an inline acceleration approach with Nvidia, where the GPU takes center stage in network processing. This technical detail is what 99% of people miss. While the world is focused on who builds the chips, they are ignoring who builds the highways those chips need to communicate. This is why the expectations of a slow Nokia are being shattered. Comment below how many shares of Nokia stock you currently hold, or if you think the shift toward Western-only infrastructure will keep driving this price higher. Nokia's business model has undergone a surgical restructuring under the leadership of Justin Haddard. They've moved away from low-margin consumer-facing segments and doubled down on network infrastructure. This unit is now expected to grow between 12 and 14% for the full year of 2026. If you're into self-investing or use an intelligent portfolio, you've likely seen the diversification shift. Their mobile infrastructure segment is now focused on technology standards, which includes high-margin licensing deals in consumer electronics and multimedia. This creates a steady cash flow floor that supports their more aggressive bets in AI. They carry over $5 billion in cash on the balance sheet, which gives them the flexibility to outpace competitors like Ericsson in the R&D race. The contrast here is clear. The market expects a company struggling for relevance, but the balance sheet shows a company preparing for a decade of dominance in specialized networking. The macroeconomic pressures cannot be ignored either. As geopolitical shifts continue to push countries away from certain Eastern suppliers, Nokia has stepped into the vacuum as the sovereign choice for the West. This isn't just a business advantage, it's a strategic one. This is why we see partnerships with defense contractors and massive government-backed infrastructure projects. When you are looking for investment help or browsing investing sites like Schwab, you'll see that Nokia's financial strength is consistently rated high, even if the growth metrics are just now starting to reflect the new reality. The stock is currently trading at its highest level since 2015, which might make some feel like they've missed the boat. But if the reality of their 49% growth in AI sales continues, we are looking at a fundamental revaluation of what this company is worth.
Looking toward the future, the scenarios for Nokia are heavily tied to the rollout of AI-native mobile networks. We are on the verge of the 6G development cycle, and Nokia is already positioned as a leader in that space. The catalyst for the next leg up will likely be the Q2 earnings report, where the market will look to see if the €1 billion order book for AI customers was a one-time fluke or the start of a trend. The risk, of course, is that the high PE ratio of over 70x leaves little room for error. If they miss a single growth target, the expectation crowd will rush for the exits. However, for those who see the reality of the infrastructure play, the opportunities in optical networking and defense 5G provide a strong bull case. We are seeing a classic momentum play where the stair-step pattern on the chart indicates strong underlying demand with very few deep pullbacks. To summarize the central insights, Nokia is currently a momentum name masquerading as a legacy telecom. The expectations of slow growth are being directly challenged by the reality of their massive AI cloud orders and their strategic Nvidia partnership. The market is paying a premium for future growth because the shift to high-margin optical networking and Western sovereign hardware is a trend that is only just beginning to gain mainstream attention. Whether you are trading on the Robinhood app, managing a Fidelity brokerage account, or using a SoFi trading platform, the key is to watch the institutional volume and the breakout levels around $12. The contrast between the old Nokia and the new AI-centric infrastructure firm is the most important narrative in the tech sector right now. As long as they keep exceeding the revenue guidance for their network infrastructure unit, the sense of authority and market dominance will only continue to grow. This is a story of a company that refused to be left in the past and instead built the foundation for the future of global connectivity. Authority in this market comes from recognizing these shifts before they become common knowledge, and right now the reality of Nokia is far more exciting than the market narrative suggests. Keep a close eye on the daily volumes and the institutional flow, as they are the truest indicators of where the stock is headed next in the 2026 supercycle. Disclaimer. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk.